$1 a day. That's it. $1. The cost of a piece of gum, a sip of coffee, the change you leave on the counter without thinking twice. Most people hear that and don't take it seriously. And honestly, that reaction makes sense. $1 a day doesn't sound like investing. It sounds like a rounding error. But what if it isn't? In this video, I'm taking 5 Fidelity index funds and putting exactly $1 a day into each one. I'm going to show you how that single dollar, the one that sounds like a rounding error, compounds differently inside each fund over the long run. And the gap between them is bigger than you'd expect. By the end of this video, 2 numbers are going to sit next to each other and they won't make sense at first. One fund will be paying $1,599 a month in dividends. Another will turn that same dollar into a $255,000 portfolio. Same dollar, completely different outcome, depending on what you chose and what you were actually trying to build. Now, before the numbers start, let me quickly set the stage, because if you're newer to investing, this will make everything that follows a lot clearer. An index fund is essentially a basket. Instead of picking one company and hoping it works out, an index fund lets you own hundreds or even thousands of companies all at once. When one struggles, the others carry it. When the broader market grows, you grow with it. It's one of the simplest, most consistent ways to invest long-term, and the 5 funds in this video are all built on that same idea. The reason $1 a day can turn into something real over 30 years comes down to one thing: compounding. The money you put in earns a return. That return gets added to your balance. The following year, the return is calculated on the new, larger balance, and that cycle repeats every single year, building on itself. The longer it runs, the faster it moves. That's why time is the most important ingredient here. Not the amount, not the asset. Time. A dollar that's been compounding for 30 years is a completely different thing from a dollar that's been sitting still. And this video is going to show you exactly what that difference looks like across 5 of the best Fidelity funds that handle it in 5 completely different ways. The first fund on this list did something the investment industry said wasn't a viable business model. In 2018, Fidelity launched FZROX with a 0% expense ratio. So every dollar you put in stays working for you. It was disruptive enough that competitors started cutting their own fees the same week it launched. FZROX tracks the entire U.S. market, roughly 2,532 stocks from the largest companies all the way down through mid and small caps. Nvidia, Apple, Microsoft at the top, thousands of other companies filling out the rest. You're not betting on one sector or idea, you're just owning the whole thing for free. The dividend yield sits at 1.01%, growing at 7.19% per year. This isn't a fund you choose for income. The reason you're here is 12.23% average annual share price appreciation and the fact that none of it gets trimmed by fees along the way. So what does $1 a day actually do inside FZROX over 30 years? Based on the fund's metrics, the projections show that by the end of year 1, the account will close at $365. That's basically your investment only at this point, which sets the stage for future growth. By year 10, the account will grow to $6,715. Year 20 takes it to $28,837. The contributions haven't changed, but the math has had 2 decades to build on itself. And by year 30, $1 a day invested in FZROX is projected to be worth $100,350. 6 figures from $1 a day. The total value added over 30 years will come out to $89,400. Of that, $87,087 will come from capital appreciation, the share price compounding at 12.23% per year for 3 decades. Dividend reinvestment will account for another $2,313 on top of that. Now, the income picture at year 30. The account will be paying an estimated $200 a year in dividends, or $17 a month, on a $100,000 account. The 1.01% yield growing at 7.19% per year for 30 years still doesn't produce meaningful monthly income at this contribution level. FZROX builds the account. It was never designed to pay you along the way. That's the honest trade. $100,000 from $1 a day is a real result, but if income is part of what you need your money to do, this fund isn't solving that problem, even over 30 years. So, FZROX charges you nothing for 30 years. The next fund charges you a fee. And there's a reason why it still takes a higher spot than the zero-fee fund. Next, at number 4 on the list, I have FXAIX. If you've spent any time around investing, you've heard of this one. FXAIX tracks the S&P 500 of the largest U.S. companies weighted by market size. Apple, Microsoft, Nvidia, Amazon, Berkshire Hathaway. When people say the market went up today, this is mostly what they're talking about. It's the benchmark everything else gets measured against. Over $750 billion in total assets. The expense ratio is 0.02%. It tracks a licensed external index, which is why it technically costs more than FZROX. In practice, that difference is almost invisible. What isn't invisible is the 13.5% average annual share price appreciation, slightly higher than FZROX, which is what drives the 30-year result past the free fund. Dividend yield is 1.1%, growing at 4.93% per year. Steady, reliable, just slow. The income here is a side effect of owning 500 great companies, not the point of owning them. Here's what $1 a day into the most watched index in the world looks like. Year 1 investment is at $365. By year 10, the account will have grown to $7,111, already pulling ahead of FZROX despite costing slightly more. Year 20 reaches $32,906, and by year 30, FXAIX is projected to be worth $124,977, nearly $125,000 from $365 a year. No starting capital, no financial background required, just $1 a day. Total value added over 30 years will come out to $114,027. Capital appreciation will account for $112,684 of that. Dividend reinvestment adds another $1,343 on top. By year 30, the account will be paying an estimated $90 a year in dividends, $7 a month. The story of FXAIX lives entirely in what the account becomes, not what it pays out. So, 2 funds in, the S&P 500 and the free fund. Combined, they've built nearly $225,000 from $1 a day over 30 years, and between them, they're paying $24 a month in dividends. If that feels like a disconnect, it is. And the next fund is the first one in this video that starts to fix it. Most people never put $1 into it. The next funds are where this video gets interesting. And in a couple of minutes, I'll show you a fund that pays $1,599 a month in dividends from $1 a day. By the end, I'll show you a fund that turns that same dollar into the biggest balance in this entire video, closing at over $255,000. But first, let's look at fund number 3 on the list, the Fidelity U.S. Sustainability Index Fund, or FITLX for short. Most people hear sustainability fund and assume one of 2 things. Either it owns a bunch of solar panel companies or it's sacrificing returns to feel good about where the money goes. Both assumptions are wrong. FITLX tracks the MSCI USA ESG Leaders Index. ESG stands for Environmental, Social, and Governance, and the way this index works is important. It doesn't exclude entire industries. It looks within each sector and identifies the companies that are leading in responsible business practices relative to their peers. Best in class, not blacklist. Which is why you'll find Microsoft, Nvidia, and Alphabet sitting at the top of this fund alongside names from healthcare, financials, and consumer companies. The fund holds 268 companies overall. The top 10 holdings make up 57% of total assets. It launched in 2017, making it one of the youngest funds in this video. Expense ratio is 0.11%, and over the past 5 years, it has returned 15.2% annually, outpacing the S&P 500 in several of those years. Dividend yield is 1.1%, same as FXAIX on the surface, but here's where FITLX separates itself from everything else in this video. The dividend growth rate is 15.42% per year, the highest in this entire lineup. And over 30 years, that rate does something to the income number that no other U.S. fund here comes close to. So let's put the dollar in and see where it actually goes. Year 1, the account sits at $365, exactly what went in. The compounding hasn't had room to move yet, but by year 10, it'll have grown to $7,114, almost identical to FXAIX at the same point. The two funds track closely through the early years. Year 20 reaches $34,715, pulling slightly ahead, and by year 30, FITLX is projected to reach $146,861. That's nearly $22,000 more than FXAIX over the same period, from a fund most investors never consider putting money into. Total value added over 30 years will come out to $135,911. Capital appreciation will account for $117,696 of that. But here's the number that separates FITLX from every other U.S. fund in this video. Dividend reinvestment will add another $18,215 on top. That's the 15.42% dividend growth rate doing real work over 3 decades, compounding in the background the entire time. And you'll see it clearly in the 30-year income. The account will be paying an estimated $2,896 a year in dividends, $241 a month, from $1 a day. FZROX pays $17 a month at year 30. FXAIX pays $7. FITLX pays $241. Same dollar, same timeline. The only difference is what's inside the fund and how fast that dividend grows. The companies in this fund were screened for how responsibly they operate. It turns out, leading companies compound well too. That said, FITLX stays entirely inside the United States. The next fund leaves every American company behind and goes the other direction. 2,000 companies across the rest of the world. And it produces the most surprising income number in this entire list of funds. And that is FSGGX. So everything in this video so far has been American companies. This one is not. FSGGX owns over 2,000 companies across every major market outside the United States, Europe, Japan, the UK, emerging markets across Asia and Latin America. All of it in a single fund for an expense ratio of just 0.06%. When you put money into FSGGX, you're not making a bet on any one country or region, you're owning the rest of the world. The reason international companies tend to pay higher dividends comes down to how those markets are built. Outside the U.S., companies have a longer tradition of returning profits directly to shareholders rather than reinvesting everything back into growth. That culture shows up in the numbers. FSGGX carries a 2.45% dividend yield, more than double what FZROX or FXAIX pay today. And the dividend growth rate is 15.15% per year. Two numbers, one starting high, one growing fast. Over 30 years, that combination does something that takes a moment to fully absorb. Let's see it play out. Year 1, the account sits at $365, every cent of what went in, with the real work just beginning. By year 10, it'll have grown to $6,762, tracking slightly behind the U.S. funds at this stage. The 9.72% average annual share price appreciation is the lowest in this lineup, and in the early years, that shows. Year 20 reaches $35,067, now pulling ahead of both FZROX and FXAIX. And by year 30, FSGGX is projected to reach $205,007, over $200,000 from $1 a day, the second largest balance in this entire video. Total value added over 30 years will come out to $194,057. Capital appreciation will account for $100,961 of that. But here's what makes FSGGX unlike anything else we've looked at. Dividend reinvestment will add another $93,096 on top. Nearly half the total return will come not from share price growth, but from dividends being reinvested and compounding over 3 decades. That's what a 2.45% starting yield growing at 15.15% per year for 30 years actually looks like in real numbers. Now the year 30 income. By year 30, the account will be paying an estimated $19,190 a year in dividends, or $1,599 each month. From $1 a day, $365 a year in contributions, 30 years, and by the end, the account will be generating nearly $1,600 a month in dividend income every single month without adding another dollar. But what if income isn't the goal at all? What if you just want the biggest number possible after 30 years and you're willing to leave everything else on the table to get it? That is FNCMX. Everything this video has been building toward comes down to this last fund. FNCMX tracks the NASDAQ composite, roughly 2,900 companies listed on the NASDAQ exchange. Technology makes up about 50% of the fund. Communication services and consumer companies fill in another quarter, while the remaining sliver goes to healthcare, financials, and everything else. What makes FNCMX different from everything else in this lineup is the concentration at the top. The 10 largest holdings, NVIDIA, Apple, Microsoft, Amazon, Broadcom, Alphabet, Meta, Tesla, Walmart, make up 60% of the entire fund. That's the reason this fund has averaged 17.27% annual share price appreciation over the last decade. Expense ratio is 0.3%, the highest in this video. Replicating 2,900 securities across the full NASDAQ costs more than tracking 500. Dividend yield is 0.52%, growing at 6.91% per year. You're not here for income. You're here for one thing: what 30 years of NASDAQ-level compounding does to a balance that started at just $1 a day. And here's what that actually looks like. Year 1, the account sits at $365, the same starting point as every other fund in this video. But what happens next is where FNCMX starts telling a different story. By year 10, the account is projected to be valued at $8,397, already ahead of every other fund at this stage. Not by a small margin either. FZROX sits at $6,715 at year 10. FXAIX at $7,111, FITLX at $7,114. Meanwhile, FNCMX is pulling clear of all of them inside that first decade. Year 20 reaches $50,021, the first and only fund in this video to cross $50,000 at that point. The compounding at 17.27% per year has had 2 decades to build, and the gap between FNCMX and everything else keeps widening. Then year 30 lands at $255,129, the largest number in this entire video. Total value added over 30 years will come out to $244,179. Capital appreciation will account for $243,524 of that. Nearly the entire return across 3 decades comes from share price alone. Dividend reinvestment adds just $656 on top. The account will be paying an estimated $47 a year in dividends, or $4 a month. on a $255,000 account. So FSGGX built a $205,000 account and will pay $1,599 a month. FNCMX built a $255,000 account and will pay $4, both from the same dollar. That $1,595 monthly gap is the clearest picture this video could give you of what the growth versus income trade-off actually looks like when it plays all the way out. The biggest balance, the smallest income. That's the FNCMX trade. And there's nothing wrong with it, as long as you knew which side of that trade you were actually on when you started. If you want to see the fastest way to make $4,000 a month in dividends, click the video on the screen to find out how.